Hey everyone, Jason Balin from the Private Lenders Podcast. This podcast you're about to hear was actually one that we recently recorded for the Hard Money Bankers clients, for actual borrowers that we do loans for. And it ended up being a conversation all about raising private capital that we felt it was very beneficial for everyone listening to the Private Lenders Podcast. It was myself, Chris Haddon, and Ian Horowitz, who we run a separate podcast with. The conversation went in a few different directions related to raising capital and creating the proper investor partnerships, how we take care of our investors and know what deals work best for both parties, and how to structure equity syndications. Ian kind of just asked us questions related to how we raise capital, because we have been over the last 15 plus years, and it turned into this podcast. So you're going to hear the theme music real quick for Private Lenders Podcast and enjoy. It's a little bit long, but I promise it's worth your while.
Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
So we got my counterpart, Chris, from Hard Money Bankers, on the pod today.
Yeah, man.
Ian came back down to the office.
Yep. And imagine that. I'm wearing the same goddamn clothes because I don't know what your guys' wardrobe looks like as you've gotten older. I swear I own 4 shirts, 2 sweatshirts, and 2 pairs of jeans, and that is it.
That's all you should have.
Yeah, no, pretty much every day I come in here, I'm wearing some variation of this right here.
Yeah.
Yeah.
Well, it's always funny, like when you listen to like books and like whatever else, and they're like, what's his name from Apple? What was it? It's Jobs.
Steve Jobs.
Wore the same thing every day, and like all I see is you're like, how the hell does that happen? Then you're like, damn it, I'm that guy.
One less thing they had to think about, right? That's
decision fatigue, as they call it. A lot of people are the same way. Decision fatigue.
Mostly
they only want to make X amount of decisions in one day. They don't want it to be little things like what you wear or what you eat. Apparently run out. Start making bad decisions left and right.
we could typically, our whole wardrobes can be HMB gear and Equity Warehouse gear.
That's what I'm down to, man. And you know what? It's okay because we were proud of our brands.
Yeah.
Not like when RJ was here. I mean, RJ always outdresses.
Well, I'm not wearing a 3-piece suit.
And I give the guy credit.
He's an agent. He's got to be fancy like that.
Yeah.
It's client work, We don't do that.
No.
I suppose.
Not like that. So.
All right, so what are we talking about today? We're going to talk a little bit about maybe raising capital, investing in some syndications. Chris and myself have been involved in some of Ian's recent deals. We came in on the equity side. Ian was raising capital for some of his deals. I was thinking maybe we start and discuss how some of those are structured. I think people are very interested, real estate investors are very interested on how they raise private capital, how they structure some of these deals. Like it's hard for people to sometimes, although we kind of take it for granted that it's easy because we've been doing it for a long period of time, how to structure some of these deals, but they're just not sure how to.
Yep.
As well as do creative stuff, have multiple investors in deals, or do equity deals where you might not your investor might not have a loan against the deal, but they actually have ownership interest in the deal.
Yeah, and I think the other half of this conversation, when we talk about raising capital, is a lot of my capital raising skills has been listening to you guys, right? Like, so it's like it's all a big trade off, and it's it's like what piece of the puzzle do you put together to get it to get the whole thing to work. It's like a symphony or whatever, right? Like there's every band piece of the band does a different thing, and next you got this nice piece of music. And you need to be able to pull out what works for you and conceptualize it and utilize it and then put it with your other pieces and make it work overall. So I don't know who's going first because like it's kind of like, three-headed monster in here. There's some heavy hitters here.
I mean, so related to the structure of the whole thing, I remember when we started doing some equity deals together and it took me a little time. There's a little learning curve to just get that front of mind. You know what I mean? Like if we're talking about the economics of a real estate deal or a loan, that's front of mind for all of us. And probably a lot of the people watching or listening now too, right? But I remember specifically related to the equity, how it would function in terms of ownership, in terms of the preferred return, money on top of that, like how it can flip, like the LP and the GP and percentages could kind of flip. That whole thing became front of mind for me over the course of like a handful of months, right? But prior to that, it was kind of like I need to see it on paper sort of thing. And so it does there's a learning curve. It takes getting used to.
True.
Yeah.
Because in our world, it was just lending. Back in the day, obviously, it was raising capital to do our own flips and stuff like that. But over the last 15 years, it's been raising capital to lend out to other real estate investors, co-lending partnerships where we put up some of the money, our capital investors would put up some of the money, and we have some sort of undivided interest in the note. And it was simple, right? Like we've talked about on previous podcasts related to having your own platform. You have a platform of the stuff you do all the time, and it fits in it, and it's very, very easy. And that's not to say that you can't expand into other types of ventures, like we did over the last few years when we invested in equity deals, we invested in syndications, we were, owners of other properties by just putting up capital. But it's not as much as a learning curve. It's just like wrapping your brain around how the structure is to see if it makes sense economically.
Sure. And like one of the learning curves from us from an operator standpoint was like, it's like when you're trying to tell your wife something, you're like, why don't you just get it? Like, this is what I'm trying to tell you. And like, I totally get it. And it's like, okay, I got to stop for a second because I took the time to put this whole deal together. And sure, I talked to my business partner about it. And I was like, hey, Dan, this is what I think we're going to do. And he's like, yeah, it makes sense. But we also talk on our own language. And then I was like, okay, well, let me take it to market. And yeah, we have a close relationship, but like there's certain things that from an operator standpoint, I'm like, I'm trying to convey it. And I hear what you're saying, but I'm like, no, it's just kind of like this, or it's just kind of like that. You're like, but so like this? I'm like, no, but it's kind of, and it was like this like dance going back and forth and trying to figure it out how to make all the pieces come together, because a lot of operators got to stop and think whether you're syndicating a deal, you're trying to sell a piece of real estate because you're a wholesaler, a realtor, lending money, whatever it is. Like if your target audience doesn't understand what you're trying to convey,
I see what you mean.
You're like wasting time. And
100%.
Yeah.
That I ran into some of that too. Like as we've gotten into equity deals with our own funds and with some of the capital that we control very closely, and then some of the other folks who've been with us for a long time, is a bit of a different process because they're just so accustomed to, okay, we do first liens, it pays X amount. And that's really all there is to know. That's it.
Yeah.
No other moving parts in that. And so there's been a learning curve for the people who co-invest with us to understand these deals themselves. And some people want to understand it and some don't care, right?
Right.
Get used to what the deals look like, why it makes sense. And I have no problem putting effort into this. Like if we're willing to put our money into it, they should be too, right?
Right.
Like we're not pitching them on something we wouldn't do, which is obviously, you got to eat your own cooking, right? One of the first rules of raising capital is like you can't raise money for anything you wouldn't do with your own money. So yeah, there is a bit of a learning curve in teaching other people, and I think it does take time. I think that when people like you drip on it more and more of like, here's why this worked. Okay, here's an exit, like the one, like the apartment building from last year. I'm sure that was huge for a lot of your capital base. They saw an exit, what it paid, why it made sense, and then they're like, okay, and then they might get that epiphany bridge, right?
Yeah. And also, I think any type of raising capital, and any time you're working with capital investors where they're going to hand off $1 to you, it doesn't matter the dollar figure. Like they got to understand. Like 15 years ago, when we started raising capital, we had to make sure, just like when you started raising capital, we had to make sure that our message and what we're kind of preaching made sense, and they could wrap their brain around it.
Mm-hmm.
You could have the best deal in the world, and you can offer the best returns in the world, but if your clientele or your capital investor doesn't fully grasp what we're trying to do, you got to reiterate it. And it was one of those things that like we think it's second nature to us. Like our deals are pretty simple, and we know how to obviously pitch that and explain that. But early on, when we were learning, maybe not, right? Like there was there was question marks and people. So I guess if you're out there raising capital, you got to make sure you're explaining it the right way. Of hey, buying this deal, it's got this much equity. There's this much capital contribution into the deal. This is what the returns are going to be. These are the pros. These are the potential risks, and kind of go through that. And again, I think somebody. It's so funny when people raise capital because it's like, oh, well, give me your investor list, or let me have one of your private lenders. My private lender's not lending to you. Ian's private lender's not lending to us, and vice versa. We're not working with them. It doesn't work like that. It's a relationship. It's a straight relationship game across the board. And typically when a capital investor comes in or a private investor comes in, no matter what type of deal it is, they're going to do a test deal with you. and if it works out and they like how it works, it's going to grow.
Yeah, I was talking to another operator inside the storage world, and he's like, I just don't get it, man. I just don't get why nobody cares about a 26% IRR.
Yeah, that's only like, one part of it.
Yeah, and I'm like, that's cool, but like, what's your story behind that? Like, what other deals have you done? Why aren't people understanding you? Like, what are you missing here? And it's not always just about the dollars and cents. In the end, especially like syndication or raising money in general, I think it comes down to people saying, I trust the jockey on this horse, right? Because, like, 100%. I was going to ask you guys, when you guys first started raising capital, did you guys get, like, a lot of pushback of, like, what idiot, like, because the other, like, I was kind of, like, listening to you is, like, you're explaining your real estate deal, but you got to remember the people that you're usually raising money from don't understand real estate, right? So did you guys get pushback of, like, what idiot would pay you that rate of return to borrow money at that rate? Like, was there that type of pushback? Or
So the more savvy people would ask that question, and then we would answer it. Like, here's why people, like a real estate investor in the space, they have different sources of capital. They can get bank money, they can get some like bridge type of, they get hard money, they can raise equity and give up half of it. Like, these are all part of the capital stack, right?
Right.
And there's a reasonable answer. And so when you give that to people who are savvy, they're like, all right, I get it. Makes sense. And, sometimes they need this opportunistic, quick private money bridge loan from us, and they're willing to pay double digit and, okay, answer the question. Some people don't ask at all.
Yep.
And they're like, oh, that's cool. Like, la, la, la. And then they're just kind of off in their own world because they don't think about finance and real estate and business like we do. Were there people who are like, oh, this sounds too good to be true, it's BS? Not really, because, like, we're not promising people 50% a year. It's like, 9 or 10% a year, right?
Right.
So, yeah, just like those are all normal responses that one should expect.
But again, and the issue with your guy at the 26 IRR, not that that's unrealistic. I mean, it's an IRR. It's not a, it's not like that's happening over time.
Right.
As you have an exit, that's why it's going to skyrocket.
But that's where that guy's mindset was, right? Like, he only concentrated on that, whereas, like, you got to look at your investor base. Sorry, I don't mean to cut you off, but it's like, when I look at my investor base, I know, all right, well, with you guys, I know you guys are getting a steady rate of return from all your hard money loans, and a lot of our other investors are close friends and family looking for consistency on their portfolio. Well, hey, man, I'm giving you 8%. And by the way, there's going to be this potential equity pop. Can't guarantee it, but it might happen, and this is where we expect to get to. And knowing who you're dealing with, I think, goes a longer way.
Yeah, but it's such a relationship game.
Yeah.
I mean, that's just what it is. I mean, money's thrown at us to invest or to help invest or co-lend with real estate investors years down the road. It takes time. A newer investor, I mean, we've talked about this before, like, probably never approach an investor who has done one deal until that deal matures and pays off and is spitting out dividends, right? Let somebody get comfortable with them, and let them reach back out to you and say, hey, I have more to invest. And it turns into a partnership. And it doesn't happen quickly. And I personally, and I'm not stating that this is the right way, I think both of us personally would agree that, like, this business is a long play. Right? There's not like, hey, I'm going to go out and I'm going to go buy $5 million worth of real estate in the next few months. I mean, can that happen? Can you be successful? Sure. But in our path, we started small. What did we do? 17 deals our first year, like $1.5 million in loans or something. And yeah, it was 15 years ago. So the average loan was less than it was now. And that was achievable for us to go raise $1.5 million in a year, right? Like, that sounds crazy.
What timeout? Was it? I see Chris laughing. Was it achievable, or was it like
no? It was
stressed
achievable
to the max.
I was just laughing at the 1.5 in 1 year.
Right.
And all of that is true. It was achievable and it was stressful.
Yeah. It was almost two deals a month, and it was 1.5 deals a month or whatever. And
that picked up quickly, and that was only year one. Like that growth and like the continued capital raising throughout. Like, that lasted for probably the first 3 years. Of like,
we went from 17 to like 50, I think, or something.
Yeah.
Or 35.
So
maybe
3x. I mean, from year one to year two.
But the point is it was like, that was our full-time jobs, and we were grinding.
Yeah.
Yeah.
I mean, we could do 17 loans in a month now on average with way less work, and that was our full-time job.
100%.
Then. But you just, that's what happens. Like, you need to, your closing ratios as you grow are way better.
we're grinding to try to find the capital for that.
Sure.
It's
It
like,
was-
hey, a loan's, someone missed a payment. Now what do we do?
Yeah.
Like you don't have stuff in place. And like,
Right.
I like that story you said about this guy's 27% IRR, because we can keep relating to that of why, like, it's just wrong. Like, it's
Right.
only one side of it. It's like, okay, well, let's say we do a deal. Let's say we had a deal and we're like, because we were charging 15% and 5 points right then. Let's say we were willing to give all of it to a capital investor. And let's say someone was buying a property for like $500,000. They needed a $100,000 loan, right? Like just like the dream deal, high rate of return. That doesn't necessarily mean that we're going to raise capital that much quicker, right? Like it takes time. It's a relationship game, and slow and steady wins the race. I know everyone wants to do this, but as quickly as possible. And it does grow. Momentum grows quickly.
Yeah.
But it does take some time to start off with.
Yeah, I mean, using that example of the 26% IRR, like if the guy's leading with that, he's going to be scaring people off.
That's what,
Tell them what it is. Like it's preferred return, like call it 10% or something like that,
Right.
plus an upside based on your ownership of the asset, and it could work out good. Like for a lot of equity stuff, since we're talking about both equity and debt, I mean, it should be like in the 15 range,
Sure.
something like that, right? Because you can get more secure stuff potentially if you're talking single digit. And then, like, if you're talking, 12 to 14, like, that's solid. Most people can't get that elsewhere reliably. And then, people who are savvy and who know real estate and finance, like, they're shooting, like, high teens or
Yep.
in the teens, call it, in
Yeah.
the teens. And if you have a home run deal and you exit it in a year and it's 26, like, fantastic. And your
Sure.
savvy people everyone will be happy. But, like, I wouldn't lead with that because that's, like, a best case.
Well, that was
isn't
the
it?
only thing that was important to him. He thought that's what investors wanted to hear, was just
I
rate of
know.
return.
Well, and here's the other question. If I came to you and said, hey, I got a deal that's going to return 26%, like, would you be like, oh, it's too good to be true? And you're probably not even going to stop
Not-
to look. You'd be like, that doesn't make any sense.
Yeah, but not now because we have a relationship. Day one, yes.
You would take a peek at it, but ultimately you'd be like, start to break it down and be like, it just seems like it's too good to be true. And you start to put up your roadblocks, right?
So if people were leading with that, yeah, I mean, that should be in your, like, if you look at, I don't know, private equity firm or like whatever, who has those home runs and like great deals and IRR calculations after the fact, and that's in your history, it's in your book.
Sure.
Awesome, it should be there.
Right.
But that's not like the big advertisement on
Right.
we're raising capital. It's 26% IRR
Right.
because that looks fishy.
You know what's more important? Like if he's going to flaunt something, more important is, what's my risk?
Right.
Not what's my reward, what's my risk, what's my exposure. And if it's like, hey, I'm buying this property for $1 million, the bank's going to put up 600, I'm going to put up 200, and I'm trying to raise another 200. Okay,
Yep.
that's nice. But chances are this guy who you're talking about, he's probably looking for 100% of everything. He doesn't have a dollar to put in the deal anyways. And that's probably what happened, because that's what does happen in that particular case.
Yeah, no, and I think Chris leads with a good point kind of connected to this is that, like, putting your own money into a deal, right? Like, that's
Sure.
the
Oh,
biggest vote of confidence. Like, when we did the Baton Rouge deal, I mean, we put up, right around 7 figures into that deal when it came down to it, that it was legit money that went out the door that's earning a rate of return. But you know what? We're side by side. Not only besides all that, we signed an $8 million loan, and we case studied that a few weeks ago on our on the One Show, but we personally signed that. So, like, when I go and sit down with an investor, it's like, hey,
And qualified for it, not just
Yeah.
signed it, not just be like, hey, well, what does that matter?
yeah,
Like qualified for it.
yeah, qualified, signed it, and have some sort of personal guarantee against that. So when you sit down with an investor and it's like, hey, here's all the benefits you're getting, and you say, well, what's our risk? It's like, look, you got risk. I get it. Look, you can lose money. We all can lose money.
Mm-hmm.
But Dan and I, we signed for $8 million, not to mention the 7 figures of money that's in there.
Oh, you had to
ourselves.
guarantee that one?
A partial carve out, yeah.
Okay.
So 50% carve out of that $8 million. So we're responsible for $4 million. That's like,
It's big.
yeah. And guess what? If we lose money, I'm paying off the $4.5 million to the investors first, and then eventually I'll get to the bank, right? Like,
Sure.
the investor money is exponentially more important.
And those are the answers that a capital investor wants to hear. If you're investing $25,000, if you're investing $1 million, like that's where, where it is. And don't get me wrong, the deal is the most important thing. But I would guess that a good deal with a good operator at a smaller, well, I know this for a fact actually, a good deal with a good operator at a smaller interest rate of return is better than a bad deal with a bad operator at a high rate of return.
Sure.
That was the only side that he was saying.
100%.
Yeah. Yeah, I don't know, man. It's just interesting to see people at market, and we know a few guys that are like guru-esque, right? Like that. You're like, man, that guy's like raising capital, but his shit just does not make sense to me. Like, how is that guy even in business? And everyone's like, oh, he's gonna end up in jail one day, and you're like, well, when's it gonna happen? But like, you start seeing some of those things. You got to ask yourself, like, just because someone else is out there touting saying, I'm doing this or I'm doing that, that doesn't mean that it's right or wrong, right? Like, you need to decide what's right for you and your investors, and how to grow it organically through what you know and understand, and not just go out there and be like, oh, well, this guy does it this way, so I'm going to do it exactly that, because our model is very non-traditional.
Sure.
Yeah. I mean, I think an important takeaway for anybody watching or listening is that, like, it should be about you, your deals, your team, everything you bring to the table. And at the same time, like, have confidence that there is capital out there for you, for your deals, if you have the right things in place. I think that there's kind of like a uneven balance situation where even competent operators think that they can't get private capital, and possibly even the other way around. People who aren't terribly competent in real estate as an operator are like, yeah, I'm going to go raise money. It's like, all right, where's the balance, right?
Yeah.
Because I've seen some funny people who are like, yeah, here's a half-assed business plan or a deal that doesn't exist, and like, I need to get in front of investors. And I'm like, all right, good luck.
And listen, I get it. Like, and we talk about this kind of on our end, the seesaw approach.
Right.
When we talk to, it's, you have a deal, like, you have too many deals and you don't have enough money, or you have too much money, you don't have any deals. And I know so many people are like, well, why would I ever have too much money and not enough deals? Well, that's a real freaking thing. And
I hear it all the time.
And if you've never come across that problem, well, that's why you don't have a lot of money, or you don't have the capital, not a lot of money. You don't have enough capital. Like, the biggest thing that wealthy people want, I'm not talking about an investor with like $100,000 of deployable capital, but even them too.
Sure.
But they need deals to deploy money in. And it's like, oh, I got all the deals, just send them to me. And it's like, you're not the right person for these deals, right?
No.
If you're asking, like, they need good deals to deploy capital in. And, passive investors that aren't in real estate full time, they don't have deals to deploy money in, right? So, but they're basing their decision making on you as a character because they don't know if the deal's good anyways, right? So, if they're a passive investor and, let's say they have money in like a self-directed IRA and they're like trying to find somebody to lend the money to or give the money to, like, they don't unfortunately have the education or the experience to know if it's a good enough deal. So they're going to lend based on characteristics of the person. But if you're trying to raise money from an active investor who's legit, been in this space, knows the stuff, obviously characteristics are still important, but it's got to be a good deal, and they gotta understand it. So I don't think it's hard to raise capital. I just think that there's a misconception in how to.
Sure.
And I think after you kind of learn and figure out the best way to have a partnership with somebody that works. And listen, if you got to give away a lot up front in order to build a relationship with somebody, you do. I mean, I know that, some of your early on deals, were structured more in favor of capital investors than they are.
Oh, the savvy
today.
ones will beat you up when they know that you need it.
Yeah.
And that's also a balance too of like, okay, we do need it, but like, how much can you give? And like, savvy people, like, they'll, these sharks will walk all over you if you give them the opportunity.
And that's okay if the deal makes sense, if the deal works, and either way.
Yeah.
And sometimes you have to kind of early on, right? Like, sometimes you have to early on just to get going, which is fine. Nothing wrong with that. I mean, we potentially had to do that early on.
I can't help myself. I'm so bad with distractions.
Yeah.
There's a guy walking around with a pink shirt, just peeking around.
Peeper.
I'm sorry.
Sounds about right. There's always something around here.
No, but I mean,
what we were saying a second ago, I was going to tell a quick story about just people's their own point of view and their perception of like what we do, what you do, everything else. I was talking to one of our attorneys a little while back, and he mentioned like, oh yeah, I know this group, they're looking to place some money, like, should I hook them up with you? And I was like, to be honest, we're just heavy on capital. Like, we got cash coming out the ass. Like, a lot of the same investors have been with us for over a decade, and like the money just grows. And he's like, you can't find the people to give the money to? And I'm like,
That's right.
That's not the right way to phrase it, bro.
Right.
Like, yes, we could find plenty of people and just give them money.
Right.
It doesn't mean they're good deals and that we're going to get it back and that it's a safe deal.
Right.
So, like, as an attorney, he didn't have that perspective on, like, what we do of constantly screening and underwriting deals and, like, making offers on the right ones and yada, yada. Yes, we could find people to give it to, but that's not really the business.
I mean, everyone could do twice as much business if they were worse deals. We could literally deploy twice
Right.
as much capital.
Right.
I mean, listen, if we want to be completely irresponsible, we could deploy 10 times more capital. But the
Sure.
point is like, we could probably deploy twice as much money, you know, and take our risk factor from, like, let's say this is like no risk or very low risk to like here, if we wanted to. And there's potentially a business model on it. It's not really what we want to do. We're not in like the just let's do tons and tons of deals with like risks. Listen, I mean, think about really what happens if you lose someone's money, how awful that would be and how awful you would feel.
It would be.
It's not
It
a
would be
position
terrible.
that anyone wants to be in. And
No.
the longer you're in business and the more deals you do, I mean, you do better deals, you know, because you learn from it. That's not to say that your first deal you ever did wasn't a good deal, but you're just naive. You just don't know. And as you grow and do more deals and structure things correctly and protect yourself, you know, you have better attorneys, you have better advisors, you have better resource vendors. Like, they're just better deals.
Yeah,
You learn from it.
I don't know that we could even, and we have some large deals, but you guys are in one of our smaller storage deals, LFG, right? Like this little, it's 15,000 square feet. It was a $400,000 all in. I don't even know on day one of real estate that, first off, raising the capital for it, but even being a good operator for it to go out to market and ask my friends and family for money to do this deal on something that I've never done. Right. Like, and I think I've talked about this several times before, is like, there's a misconception of like, oh, you guys just jumped right into storage. It was cool. No, like, we cut our fucking teeth so hard in single family and refined our process and figured out who and what we are and where we excel to get into that, the same way you guys have cut your teeth of lending money over and over and over again to, boom, here's this refined thing. Let's open a new office in this location because we have the right partner there. Right. Like, so I think a lot of people need to take the time. Yeah, you might be able to raise capital. It doesn't mean you should go do it. You should probably figure out how to do this deal with your own money first and then raise the capital behind it when the time is right.
And not everyone's in a position to obviously do that. But
Right.
but the point is, you know, let's say you have a $100,000 deal locally. You need to raise $100,000. Like, you better have everything as much skin as possible into that deal. Obviously, sweat equity, you know, is part of it. That's important, but everything. Like, that investor not only is not losing a buck principal, they better not be losing interest either. Like, you're treating that thing, you're doing everything you can. And that's why it's irresponsible to do lots of deals before one deal ever performed or matured. One of the biggest mistakes I've ever seen with real estate investors flipping houses is they try to flip 4 houses before their first deal paid off. Right? They do.
And it happens all the time.
It happens all the time. They do their first deal, they raise capital for it, it's going along smoothly, they're doing some construction.
Let's get another.
Hey, it's time for another one. They do another
Uh-huh.
one. Then one goes bad, and then they're, you know, taking budget from this, putting it towards this, taking budget, and then all of a sudden they tank, just like that.
Yep.
It's the worst possible thing that could be done. Listen, a lot of our capital base grew because we did one deal that performed, and they wanted to do another deal with us, and they wanted to do another deal, then they wanted to, refer a friend. Same thing with us. We did a deal. It's like, hey, this worked. This deal paid off. Well, we learned from it, or this deal had some speed bumps. Why did it have some speed bumps? Okay, those are speed bumps we can live with. Let's readjust next time. We do 2,000 deals. Then it's like, hey, let's bring on a partner in another market. Let's see how that works. You know what's interesting, that I don't know if you knew this or not, and this is something to think about just in general, that I think is a good thing to share. So one of our markets that we have is New Jersey. We have an operator in New Jersey. For the most part, unlimited capital to deploy. Like, we would do every good deal that we could in that market. You know how much volume we did year one?
In which
a
market?
question I don't know, Ryan.
No, I don't remember.
Where are we
I'd
at
be
now?
guessing
Where are
if
we
I
at
say.
now?
Deployed maybe like 6-7 million.
Okay. After 3+ full years in business with unlimited capital at his disposal in a market that has, big thing. That's all we have deployed in that market.
Yeah.
We could deploy $20 million in that market, and we'd like to. The point being is it takes time, and we're learning from it. We're not like, the first 6 months, it wasn't like, hey, go out there and figure out a way to deploy $5 million. Like, every day we're communicating and be like, hey, there's this deal. These are the risks. Hey, is it worth doing this deal? Every day. I mean, we got 3 of them today from Ryan that we're making a group decision on. Could we have gone and deployed $20 million year one? Yeah, we had the capacity and the ability to do that, but we didn't have the proper deal flow. It just goes to show that, like, you don't just jump into things. And sometimes the biggest financial, it's the most irresponsibly financially when you have tons of capital because you don't have the discipline to be like, oh, I got to deploy this as quick as possible.
Sure.
And that gets you into trouble. So just I like the seesaw approach of like, hey, let's go find a deal. Let's go raise some money. Let's go find a deal. Let's go raise some money. Let's go find a deal. Let's go raise some money. And it grows like that responsibly instead of being like, hey, I got all this money. Cool, let's go get deals. And then it's ramping up, is just a recipe for disaster. You don't learn from it.
For sure.
I was going to ask a completely different question, but then I'm sitting here thinking, you guys talking about deploying $20 million. I kind of know your loan volume that you have out now. It's up to you guys if you want to disclose it. You guys ever get like agita thinking about how much money's out on the street of like, God damn, like, we have a lot of money out there?
Honestly, no. Do you?
Well, why?
You ever get stressed out about like the size of our portfolio of like?
Why? Because it should be. You think?
No, just say like going. Okay, like so let's say 2 years ago, going into COVID, you guys got say $40 million out on the street. Yep. Did you guys go? Oh my God! This is the event. It's coming.
So that is probably that's the anomaly. That's probably the only time that we've
Right.
seen something that crazy that would make you think that. Because we know we're into good deals and conservatively under it. And like, across the board, we're probably 50 LTV, maybe less on our portfolio, right?
Sure.
So something like that, a pandemic's coming, it's a world ending sort of thing that you have like, you have those thoughts in that case, but in general, no. In general, like I'm not stressed out at all about our outstanding portfolio.
Wait, are you saying that as
he's saying we have,
we stress because we have so much, or we don't have enough? And,
No,
and
like,
the market's $1 billion.
No.
We haven't hit that.
He's saying, are you stressed because you have so much exposure? You have $40-50 million on the street.
Yeah.
Does that keep you up?
Against $100 million worth of assets? No.
Yeah, I mean, like you ever go to bed
Never.
and you're like,
Never.
Man, what if? Like,
No, because I feel like we're very conservative and cautious, and I'm not just saying that because I think that's like the go-to that everybody says. Like, I think your stuff's really risky.
Right. Well, meanwhile, I'm asking you because I'm like, God damn, like, there's no way I could do that. Like, especially like the way interest rates and things are happening. I'm like, I would not want to be in loans, but then I'm like, money cycles back, and then I'm
you
sitting here.
almost have that.
Yeah, but I'm in hard assets, like hard, like equity. Like I can ride the wave. Like I know we bought well. It's like the same
but we
thing.
are
Just
It's
say
the
it
same
different.
thing.
But we
I
are.
mean, it's slightly different, but it's the same shit.
Like we could debate this, but like I think we're in a way better position than you are.
Well, I don't have my business partner here to tag team in, so it's 2 against
Yeah,
1.
it's
So this
2 on
isn't
1.
fair.
Let's change the camera angle, then we'll go 1v1.
Yeah, all right.
No, but the point being is like, okay, so I mean, think about it like this. $100,000 loan, right? A borrower has, let's say, 40% of their own money in, plus there's equity. We have 60% in.
Sure.
Like, they have a lot to lose before we kind of even get in trouble. There's a lot of deals that have gone bad because they couldn't perform.
Mm-hmm.
And, it's not big headaches to us because we're properly positioned. And, it's hard to kind of lose on that. Could that happen? Absolutely.
Yeah.
But, it's just like buying anything. I mean, what happens on your guys' end if, the market goes down 30%?
Yeah, I mean, we're gonna ride the wave.
Yeah,
we have equity investors to ride the wave with us. They know what they got involved in. We conservatively underwritten that. We're buying it. Hopefully, 50 cents on the dollar is where we expect to be at current market time. So if it goes down by 30%, that's fine.
Yeah.
Our biggest risk, in our situation is if that goes down. If value goes down, what happens to market rents? That's our biggest risk. So. In the fact of hyperinflation, well, things are getting more expensive. Is there going to be a hyper deflation? That's my biggest risk. I'm not. Do you guys like what you? Well, you guys are. What do you think your biggest risk is?
Do you know our main reason why we've never taken on institutional capital? I'll tell you if not. Besides that, it's a headache, obviously.
Yeah.
I mean, it hedges a bit. Okay, if we take on institutional capital, like the way that we're structuring our deals with private capital and our own capital and not taking on institution is like a humongous insurance policy. If we take on institutional capital, obviously, if we just took on one bank and they funded our whole portfolio and they go out of business or they call our line, we're screwed. That's part of it.
Sure.
But also, like, we have individual capital investors. We have our own money in these deals. We can do individual workouts as we see fit on each one. $100,000 deal. Let's say it goes sideways. The borrower disappears. We got to figure it out. Cool. We have a conversation with one capital investor. Let's say, we have some money in, the capital investor has some money in, and be like, what do you want to do? Should we take this over? Should we rent it? Should we try to sell it?
Right.
Or we talk to the borrower and they're like, hey, maybe we reduce the interest rate and try to keep it out. Like, each individual deal we make a decision on, and we've got comfort when we went into each deal itself that it's a good asset. And obviously we were conservative on the front end, but like, we've already thought through this. I mean, we know for a fact that, deals, better operators with slightly higher LTVs will perform better than, less qualified operators with lower credit scores, even at lower LTVs.
Sure.
And it's just not structured in a way that anyone can pull it from us.
Yeah. Well, I was going to say,
Right.
in the end, like, it's about it's control, right? Like, you're controlling your capital, you're controlling your investment the same way we control our investment, and our capital investors are, silent or passive side by side with us, right? And we make the decisions to do what's best for the portfolio. It's a similar situation.
And keep in mind, debt typically has more control than equity.
Is this turning into a competition, a debate? Because, we
Well,
don't
you're
pay
fair-
taxes. I just want to, what's your tax bill?
You win on that one.
Yeah, okay.
You
all
win
right.
on that one, bro.
Being the owner of real estate does help with that. I mean, most of our stuff's income and expense and not asset liability. I get that.
But
but listen, I mean,
I can't get the last word. I can't win. I
go ahead.
can't win.
Go ahead.
No, go ahead.
Shoot.
I'm done.
No, if you're...
No, I
if
was
you want
just
the
gonna. I was gonna say, look, in the end, like, all this goes back to your original. If you want to tie this back to raising capital, it's being confident in your business model, right? Like, we all know our business model inside and out. And like, I'm an investor in some of your deals. You're an investor in some of our deals.
True.
And I'm totally confident in you guys. Besides our friendship and everything else, I know that our deals are going straight, and vice versa. I feel that that's the same. And this is what people need to do. And I don't think enough people take the time to stop and say, do I know my business inside and out to be able to raise capital properly and do the right deals?
They don't, because they don't treat it as a business. They treat it as not a hobby. That's not the right word, but like
It's
this
passive.
is serious. When you're taking
Passive.
on someone else's money,
Yeah.
yeah, exactly. They're taking it as passive. It's like, oh, I just buy this piece of real estate.
It's
and
passive.
then it works. Nothing's freaking passive.
And somebody posted that recently about storage. Like, it's a business, not an investment.
AJ
And,
Osborne today.
and it's both. Like, in reality, it's both.
Sure.
But, like, don't forget one side of it, right?
Yep.
Like,
Yeah, I mean, there's no such thing as passive. I mean, I shouldn't say that. Operating our businesses are not passive. And it's like, oh, let's go buy some rental properties because I'm going to get passive income off that. BS.
Well, from a taxable standpoint, when talking to your accountant, that's the terminology you use.
yes, people are typically not talking accounting when they say that. Though.
Yes.
They're talking, like, a reality lifestyle.
Yeah.
But when you invested in our deals and we invested in your deals, it is a little bit more passive.
That's way more towards
Correct.
passive because there
It's
is an
more passive.
operator involved.
But again, it's not like, hey, let's just give you money and go have at it. I mean, we're properly underwriting these deals to make sure that they have the ability to do what they said. I mean, your money's valuable to you because you could potentially deploy it in ways that seem fit to you, and our capital's valuable to us because we could deploy it in hard money loans.
Yeah. I think we did pretty good with that piece of the subject.
Okay.
I was gonna, because I want to ask Chris, because you do, if my understanding is correct, you do a lot of the investor relations. Like, what's someone can do for like investor relations? Like, like, we're talking about all the ins and outs of the business, and like sometimes the investors don't necessarily care about that. Like, you guys do a pretty good job. Like, and to tie it back is, I get my email on the first of the month or whatever it is. I'm like, oh, well, cool, loan paid, and every once in a while I'm like, hey, my money's sitting dead. Like, what are you guys doing? You're like, yeah, don't worry about it, and it's good. Like, what do you do for investor relations?
What do I do?
Like, just managing like investors, like, is there like some tips that you give to someone to be like, hey man, if you're raising capital and you get the capital, like, what should you do for like investor relations?
So at the beginning or now? Or both? Or I could touch on both.
So let's just go through the cycle. Let's go through the life cycle.
So towards the beginning, there was a lot more heavy lifting, a lot more manual stuff to be done. I used to do a lot of stuff. Like, there were frequent meetings lunches, in-office type stuff. Once you start developing a relationship, you go out, maybe play some golf, maybe go on somebody's boat, like stuff like that. I used to go out of my way to do certain things that I thought would get people's attention. Like I used to drop off their checks by hand.
Sure.
By car. Like I would drive them over and give them their documents. And granted, this is back in the day before everything was so electronic, like you were saying about the ACH payments and like statements by email. I would either have to overnight them or like FedEx 2-day their closing package and checks to them. Why don't I just drive it over there? Right. And so I got some people's attention by doing that a number of times. There was more marketing that would go on in terms of I never wanted to present any deal that was available. I only wanted to market deals that were already closed so that people would, psychologically kind of behind the scenes arrive at the fact that other people are investing this and I have not gotten in on it. So I would market closed deals in terms of like sending email broadcasts and everything else. And so it was just a lot more manual instead of automated. And so today, a lot of the stuff is automated. Like you mentioned, the statements will go out on the first of the month. Every Tuesday, there's an ACH transaction. That's an electronic payment from our system along with an accompanying statement showing what you're getting paid that week, which is like these are just pinging our investors constantly. It does a lot of the investor relations job. It tells them what they need to know about their deals. If something's gone sideways or like there's a default or something like that, then we'll have to have an email or a phone call about that. But it's doing a lot of it for me. And then there's still the relationship kind of ongoing, like real relationship. Like it's become a good time over the years. And the same stuff happens that was happening at the beginning, only for it's just like, an ongoing relationship maintenance, fun time kind of thing. Like we're still going with the same people on the same boat. We're still going a couple times a year for a steak dinner. We're still stuff like that, right? Still happening, still playing a round of golf once a summer.
Right.
So yeah, it's a combination of that. Probably, 80% of what goes on is just the automated system that we built over time. And then 20% is really putting effort into those relationships.
Yeah, I would say the best piece of software that I've ever bought was Syndication Pro.
The one that you're on now with the statements?
You guys literally log in. You can see how much money you deploy. You guys put capital investors into deals, and it's like, boom, their information goes right in, and I can just crank this stuff out, and that automation piece is just amazing. And the investor touch, that stuff's real. Like when I send out like an email that says, hey, you're getting your quarterly distribution. I'm not going to say we're going to monthly, but we're really close. Is that when we do our quarterly distribution, I send a video out, a little update of, hey, this is what's going on with the asset. How many people are like, dude, I'm so excited. I can't wait. By the way, I got money in the wings. And I was like, yo, all that shit Chris has been telling me for years is real, because I've sat in this chair and it's been all over this damn office. Chris,
True.
The same exact
the same
lime
exact
green chair.
Yeah, it's been all over this office. Like I was like, hey Chris, like how do you raise capital? And you're like, dude, you got this. Like, what are you worried about? And I'm like, nah,
and I've been saying the same thing all along, right?
Yeah,
like my story hasn't changed.
Yeah, no, and it's really just started.
When we figured that out a few years in, it's the same thing.
This is not a song that needs to be remixed.
No, not at all,
dude. The biggest tip, and we discussed this obviously, is everybody should pay their investors as much as possible. Not return wise, but frequency.
As frequently as possible.
As frequently
Those touches
impossible.
are huge.
And your industry is known to do quarterly distributions. You get up to monthly distributions when no one else is doing that. And I know that's a little bit more complicated, right? Mostly because, on the equity side, you got to reconcile books.
Yeah.
To figure out what's what. On our end, it's a little bit easier. But I mean, people, most of our stuff's getting paid in real time. But when we went from once a month to once a week, or whenever money came in, you can't stop it. Money just comes in. Like nothing better than a private capital investor, or just you personally, right? You invest $100,000, and then like on a regular basis, it's like ping, ping, ping. It's free. It's not free money, but it's like it's money that's coming in on a regular basis, and then you start investing more with that with that sponsor, and then it's ping, 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 and it's like non-stoppable. It's a literally dream that everybody wants on a regular basis. And when I have like new real estate investors that reach out, be like, oh yeah, I'll just pay them on the back end. It's like, don't pay them on the back end. Like, so that means you're going to do a deal, and in like 6 months from now or 7 months from now, you're going to touch them once, be like, oh, here's your payout. Pay them on a regular basis over and over and over and over and over. Front of mind. It's like the number one tip.
And to go back to that 26 IRR guy, I said, well, what's your plan? He's like, I'm just going to do a 50-50 deal, right? No pref. straight up
we're talking about
50%
this.
equity, right? And I was like, all right, so you're telling these dudes are going to make 26% on their money. They don't really know when they're going to get paid. There's no stability across it. I said, change the equity piece just a little bit. Weight it. 60-40, 70-30, whatever it is. However it works out to get to your same 26 IRR. But give them some sort of preferred payment so you're paying them every month. So now this is a real investment to them, or every quarter, it's a real investment to them. If they're just waiting to get a distribution, it's like, well, when's it coming? When's it coming?
Right.
You know, like I was talking to, Shane Chapin. He's got his deal that he did in Macon, Georgia. He's like, well, I want to do a distribution. I said, well, he did a 50-50 type deal, equity only, no pref. And I think it's a good deal for what he was doing. And he'll gladly tell you this, but he was getting ready to do a distribution. And I was like talking to him about it. He's like, I want to get the money out so these guys see that it's real so I can do it over and over and over again. And that's one of the things that you got to combat. And you got to decide up front early on, how do you want to do this? For us, the 8% and the pref limits the downside risk to the investors because at least they know they're earning out 8% on their money and it's coming out in real time.
That's right.
On a quarterly basis.
Agreed. The more money you can get back into your partner's hands, the better. Absolutely. And, we talked about this. We learned a lot over the last few years on structuring equity deals. I mean, we've been invested in lots of different types of equity deals, including syndications. I love syndications the best because typically, you're getting a return.
It fills your real estate bucket, and you don't
fills
have to
the real
deal with
estate
the
bucket. We get all that, but some of these things aren't going to have a gigantic hit like a potential just equity deal that ownership equity in a startup.
You're talking about like a venture capital deal versus equity in real estate.
Exactly, but the beauty of it of these, from what we were talking about, that you learn a lot from is kind of creatively structuring some of these deals and figuring out ways that you can just limit your investors' downside on the front end, and then potentially how it performs. It's like the way that you structure things is it's value add basis. You're not getting paid. Your investors are getting paid first, which I believe should be the case. Like, right, you get on those particular deals. Hey, the investors are taking the majority of the risk on the front end. Let them get paid. Less downside risk. So even if it flip flops, like, I feel like people don't understand how to structure deals in general. Like, they just can't wrap their brain around it. Like, how do it's like
they just don't know the common structure.
Yeah,
I mean, that's all you really need to know. Here are the common.
But you can set it up any way you want. Like, for instance, there's nothing wrong with being like, hey, investor, you have 80% ownership. I only have 20% ownership on the front end. But as you're getting repaid, and as you hit a certain, threshold hurdle, then we flip flop it. And then I get the 80%, and then you get the 20%.
That's actually the exact question I was going to ask when we were talking before we got on camera. Is why didn't you ever decide to do it that way? Like say,
a traditional waterfall model.
Exactly. Like the LP starts with 70%, and then once they get their principal back, they go to 30%, and the GP goes to.
It really comes down to us as operators and the complication of saying, okay, well, I hit this target IRR and like proving it out and like trying to sit down and be like, this is how it worked, and I can't even explain it. To me, it's like the simplicity of this is how the breakdown is, and we did like a quasi waterfall type deal on
Gaslight.
Gaslight only because there was massive amounts of risk.
Yeah,
right.
Because it's such a big value.
And that's the part I'm talking about mainly, not even in terms of rate of return, but just in terms of worst case scenario.
Yeah.
Like worst case scenario, this thing goes totally sideways, and we have to fire sale this thing. The LP is going to own 70% of it instead of 30%. Kind of.
Yeah, thing. but they kind of did because there's kind of a debt. There's an equity debt blend component in there, so that debt component chews up. It's not ownership equity, but it still chews up the amount owed to the capital group through that debt piece.
Right. And
I kind of know what you mean. I'm just saying, like, the optics of it, I think would make, in terms of raising capital, I think it would make the sponsor's life a little easier because you can say, hey, if this thing goes sideways, you own the majority of it. You're going to get your money back in all likelihood unless something goes crazy wrong. Just in terms of the optics in a capital raise, I think that would be helpful.
And like one of the things we were considering going in this deal, and I bounced a lot of ideas off of Jason as a potential capital investor. I was like, what if we just did a 8% IRR hurdle? So if we service the pref and then any cash that comes in that, so let's just say it only makes 8%, or we're negative cash flow and we're servicing your 8%, right? You guys own say 65 and we own 35, but as soon as we make $1, that target hits. and then we own 65 and you guys own 35, right? Like that's the waterfall. We talked about that, and then it was just like getting so convoluted for us that it was like, I don't know. And like I had talks with so we hired a professional underwriter to help with the Baton Rouge deal, and he talked about that. And I was like, well, this IRR and like a lot of the IRR metrics that these guys do inside these waterfall deals come from the forced sale, and we're not looking to sell. And that's where a lot. So when you're looking at guys buying 4 caps and debt's 2% or 3%, and it's like, well, how the f are they making money? They're only making money because they're selling that asset, hopefully in 5 years at that same stupid cap rate.
Gotcha.
Then they trigger the IRR and they get paid out. And
They didn't
that's
want
not
to
our
be forced.
goal.
You don't want to be forced to.
I don't want to be forced to do anything to hit a target IRR.
So the way that like Gaslight was kind of a win-win setup is there was less equity that was given up, but a tremendous interest rate return given up.
Sure.
And that's that incentivized you to pay them off quickly. But you also were under the impression, and hopefully this is true because we obviously have equity in this as well, that particular deal was such a big value add that it goes from like here to here. A lot of these other deals don't have such big fluctuations. So in your end, and in everyone's end, it accomplished the same thing by it's like, cool, if that's the case, you don't want to give up because they were really equity conscious on that one. They didn't want to give up so much equity. It's like, cool, well, let's pay the investor group a really, really, really rich interest rate worth return, knowing that they're not going to get the equity upside or the massive equity upside, give them a good, rich interest rate return, knowing that, hey, if you pay them off quickly, as quick as you want to pay them off, they're still getting a handsome rate of return, but they're not giving up tons and tons of equity.
I think we structured it in a way that if there's a capital event through refinance or a capital event through sale, that we're all well protected together. And again, that goes back to like sitting down. I kind of knew that you guys were the right investor group right there for the majority of the capital, that it was like, all right, guys, like let's sit down and figure this out for the win-win. But like when you're looking at something on mass scale, it's like, all right, well, how are we going to do this? And like, if your guys aren't my only investor, like what works for everybody in this deal? That deal had we're talking about almost a multi-7-figure payday, almost 8 figures, right, on that one. If everything goes right, potentially that there's a lot of upside in that one versus some of these other ones. It's, I don't want to say marginal, but it's just status quo.
Yeah.
And the other thing is a lot of those guys in the traditional model, they go out and just bang fees left and right? Like, due diligence fee, asset fee,
It's just
acquisition
it's like a corporate asset for them.
Well, you know what it is? It's the same as Vanguard charging you 1.5% to manage your mutual fund.
Right.
It's just
Management fee.
all they give a shit about is that
management
2% and all the other junk fees to keep their shop open, and they're just trying to get the 2% a year on $1 billion worth of assets, and that's not who and what we are. We're here to do real deals, and look, we don't get, if your 8%'s not getting serviced, we never get paid. So there is technically like a little hurdle in there that your 8%. And I get what you're saying. Maybe from an equity standpoint, it's better for the investors. But on the same side,
just from risk management standpoint,
correct.
it's the only part.
That makes
like
sense.
Yeah. Well, I mean, because I got a good question from a very savvy guy, and a very savvy guy, and a lot of people are. But I mean, like he's an operator. He's a real estate operator, which is like there's pros and cons to that in terms of equity investors.
Sure.
And what he said was, so I'm putting up this percentage of the cash, but I'm getting a far less percentage of the ownership.
Yeah.
And I was like, fair point.
Yeah.
A fair point, right?
And also, you can flip-flop that really easily.
Sure.
Because it doesn't really – it only hurts you. I mean, it doesn't really hurt you at all, actually, because it's only benefits the investor, right? Let's say, because you like to keep 65% to yourself, 35% to the investors, you flip-flop it with the hurdle that after you reach a certain amount, it flip-flops back, which makes the investor group feel more comfortable because let's say like you just walk away or the deal completely falls apart. They retain that 65% at the beginning. Like you can almost structure it without it changing anything besides, the investors potentially feeling.
I mean,
better.
in the end, you got to do what's right for you. And, what can you sit down and talk to someone about and be like, this is what I'm confident in. I start talking about hurdles and flips and flops and you own this and then you own that. And then like tax side of things. And like, then it just gets like really convoluted.
But
which
here,
is no good.
But here's another thing to think about. And this is an important factor is how big you're trying to scale, how many investors you want in. Like when you're trying to do Grant Cardone stuff or even AJ AJ Osborne stuff. Like, that's bigger scale. Like, you have to hit the masses. Like, you don't know all your capital investors. You can't know them all. You have hundreds of them. You have thousands of them.
Yeah, crowdfunding type stuff.
And on that, like,
They're trained.
Yeah,
They're already trained by everyone else.
yeah, like that, like on that setup, it is different. And like, you're just, because when I was talking to one of our capital investors in this deal, he asked the same question, like on Gaslight, like, this is standard. They're doing this. I was like, yeah, but, and I was playing kind of both sides of it.
Sure.
Right. Because I was learning. This is a while back. I was learning. I was, representing some of our capital investors. I was trying to, work with you on some of that. I was like, that's true. But like, these guys are on a bigger scale. Like, not you. They're on a bigger scale. They're doing tons and tons of stuff. The margins aren't, their margins are slim. Like, this isn't a value add deal. Like, you're right. In that particular case, it makes sense. But like, if you're trying to keep your business model the way it is, which I personally think is a good idea, every one of your capital investors. You can have a conversation with all of them. You can be like, this is why this makes sense. This is why this doesn't make sense. Kind of same with us. Like, we don't want to do hundreds of millions of dollars worth of private capital deals. Like, we have good relationships with all our capital investors. We want to keep it that way. We want to do a one-off workout if we need to. You want to do a one-off workout if you need to. Like, let's say one of your capital investors has $50,000 and it's like, Ian, I really need this money back, blah, blah, blah. Like, you'd have the ability to give them the money back. And obviously you would never promise that or write that into an agreement. But when you're that size, in my opinion, if you're that size and you're still hitting the financial goals that you want, like, you won. Like, you're in a good spot. And that's where I feel like we've always been in our lending business as well. And I feel like you guys are on there. And obviously, like, the game changes when you're trying to get to a bigger platform.
Sure.
Like, if you're trying to do many, many, many more deals, like, you do have to set it up kind of more standardized.
Well, and I would relate the two is that I don't want to be a fee shop, and you guys don't want to be a fee shop. The way we set our deals up is because we don't want to be a fee shop and just collect fees. We want to do deals that are real, that provide real cash flow for all of us long term. You guys could take institutional capital, but guess what you're going to become? A fee shop. You're going to get your points. You're going to get your little bit of spread on your book, and that's it. You're just a junk fee shop. What fun is that?
You want to treat it like a family office, right? We treat our business like a family office. You treat yours as
I love that idea.
Yeah, you treat yours as a family office. Like, you're not bringing in asshole investors that you don't want to deal with, and it's like, screw you. Like, you're not the right investor for me. Same as us. Like, you don't bring in the, just because someone wants to invest with you doesn't mean you're going to take their capital. Anyone who wants to invest with, I'm guessing the Grant Cardones of the world, sure, I'll take your capital, whatever. It doesn't matter. Like, that's not how it works. Like, you kind of have to set up that, like, we're a partner in this. You're doing me a favor and I'm doing you a favor. Like, I'm helping deploy your capital into a good, strong asset, and you're doing me a favor by, deploying money into our deals that I need capital for.
And I would also combat that statement, not combat, but I would take down the roadblock of, we did sign an $8 million loan, right? Like, it's not like we don't have personal risk in that deal.
Of course.
Yeah, I'm not saying it's a roadblock. I'm just saying that's like one of the things you could
put
say.
Up
like,
real capital too.
Well, number one, we put up real capital. Number two, we're signing on this thing, man. Like, we're all in. Like, I get what you're saying, but in the same sense, like, dude, I don't get any cash flow until you guys are serviced, and I've signed all this crazy shit, Like, and that's just and I get like wherever people are. Again, they're trained. Like, you're trying to. And I had someone, Schwartzberg. He's like, stop it, man. I'm like, what? He's like, stop fighting inertia. Just give in and do it the same way as everyone else. I said, why? Why would I do what? Just because it works for them, why am I going to do it? It doesn't work for me. I don't get it. I don't understand it. I can't sit down and explain. Here, I know my investor base, and they're very close from my past work experience. There's not a ton of sophistication. It's, hey, man, this is how the deal works. It's pretty damn straightforward, and that's it. And that's why I do it that way. And he's like, yeah, I get what you're saying, but I'm telling you, man, you should just do it this way because that's what everyone else is doing. I'm like, well, that doesn't really mean it's right, So,
I agree.
So I have
You do it the way that fits best for you. We run our lending business very different than everybody else. Everybody took on institutional capital.
Or they have a fund set up, right? And they're always servicing money.
Like, you set it up that works best for you and your business model. I'm for some reason just against just going super, 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 super big, and then all of a sudden you're just scaling, and your margins are just getting lower and lower and lower, and then all of a sudden you are just a slave to that business, and you have to continue to do deals. You have to continue to be involved in it all the time. Like, why not just do a smaller amount of deals that are very, very, very profitable, and you have a good thing going? And sometimes it's ego oriented, status oriented. I think you go both ways. Sometimes I see in your eyes that you want to go super big, and sometimes it's like, hey, like it gets to the point where it's like enough is enough. And like we've had Jimmy on this podcast before, and I love it what he said. Jimmy Harris, he was like, if I could do one deal a year and make my $1 million a year, I'm happy. And I agree with that.
It's the wet dream right there,
I agree
man.
with it.
You know, like if you could just do it and knock it out and be done, be like, all right, I got 11 months and 29 days left. You know?
Exactly. If it worked that way, that
Yeah.
sounds kind of nice.
And
Yeah,
it
it
works.
sounds
But
amazing.
it depends on what people want, right? Like it depends. So
So I asked Jimmy last week. I was like, if you could go public, would you? Like, if there was like no roadblocks to doing it, would you do it? And that's kind of. It
Like
was like
publicly traded?
yeah, I don't know.
Oh, God.
No.
Sounds like so much brain damage now.
Yeah.
I think would be like twisting everything we want to do into someone else's system.
I mean, because at your size, you guys could probably get on pink slips, and get traded somewhere out there.
There is a New York-based hard money lender, probably not too much bigger than us, that is publicly traded somewhere.
Yeah.
And I'm like,
what do they call
why?
it? Pink sheets, not pink slips. Pink sheets or
The
one of
pink
those.
sheets are like penny stocks, right?
Yeah, exactly.
Like the Wolf of Wall Street shit. Yeah.
Well, you guys know the other guy that we partnered with that would lend some hard money, and he's like, I just want to get to like $20 million of my own capital, and then just get it publicly traded, just so I could have my name out there. And I'm like, why did you do
an
that?
ego play.
That's ego.
Yeah,
An ego play.
Yeah,
But
you know
like
who
you want to
it
be
is, yeah.
super regulated and
Dude,
like
you can-
lawyers up the ass and
Yeah.
some
You
Can't
submissions
overlap
and
ego
accounting.
in it. Like
Yeah,
I mean, like I prefer to wrap ego into business in other ways. That's not one of them.
yeah.
Not like the public. Like anyway. That's
Yeah,
that's another podcast. That's
well,
another
yeah, no,
conversation.
I just looked at it from like an asset management standpoint of like, if I could get, it's just like an unattainable goal. Like Grant Cardone, 10x this, 10x that. And it's like, well, what's an unattainable goal? All right, go in public. And then I'm like, I was with all the Life and Air boys last week, and they're 2 weeks ago,
Okay.
and they're like, what purpose does it serve? I'm like, I don't know. I'm just trying to make a goddamn
God,
ridiculous
I hate
goal
those
to
answers.
work towards
Questions.
some. But then I took both sides. Like you take a little bit of everything, like Jimmy was saying last week. It's like, all right, you're right. I want this stupidly large goal, and like, what is my purpose? And then I started thinking about some like other cool ideas, like if we did get to like some sort of like, and we're at a nice critical mass now, but it's like, what does a relationship with employees look like? Can I create? Can I help with first responder financial freedom? Like, because we know a lot of people inside that. Like, if we grew a little bit more, could I give back that much more? And it's like, all right, well, I'll take a little bit of what you have and a little bit of what I have, and like, let's mix the two and make it serve a purpose.
Yeah,
Besides just cash into your pocket, which we all enjoy.
it depends on what you want. I agree. I just how it goes. The bigger you get, you're going to be less involved in some of the things
Sure.
that you mold it. You mold your day into what you want it to be, and
Well, that was all right. I know we got to go because it's like we're a little bit past an hour, but I want to tell a story and maybe even ask you guys this question. So last week 2 weeks ago. Sorry, God damn it, 2 weeks ago we're at this mastermind, and I was talking to him. It was my share, and I said, are you an asset manager? Are you an investor? Like, how do you view yourselves inside your business? Because I know you guys do a pretty good job of like allocating your capital and making it investor capital. You guys asset manage on a day-to-day level, but you also act as an investor. Right. And like we were looking at is we used to be day-to-day operators. Now we're moving up to asset managers. I want to get to that point. Like I feel like asset manager is a good title for us because we're managing all the assets and we facilitates everyone's investments. And, how do you kind of view you guys yourself? Like,
I mean, we want to be full-time investors.
right.
That's it.
Yeah, I've never really dove into the term asset manager as
Yeah.
it relates to our particular niche. I'm going to think about that some more. I don't have a great answer on that.
Does kind of make sense a little
It
bit.
does. It does. I've never really thought about that one, but I was watching a video that Jason did and doing an email broadcast about it the other day about the investor operator blend.
Yep.
And I think that for the foreseeable future, for a long time, it's going to be a mix of that.
Yeah.
Right. Like we do deals, we run a company, manage employees, like run the operation, which I want to. And at the same time, we're investing in our own debt deals, in equity, in, a property here and there. And I think it's going to continue on as such. Like I don't see why not, right? Like
I like being a full-time investor.
Yeah.
And also there's an argument that still running our company is not being a full-time investor. I mean, we're investing in deals every day.
yeah. I mean, if
Every
you
day.
have like transactional work to do, like you're an operator,
Yep.
right? You
Agreed.
are.
But that transactional, but you can, in our business, and I'm not saying or your business, it does overlap that our business is investing in assets, right? So it's kind of the same thing. It's like, hey, every day we have deals that come in. Every day we underwrite those deals. Every day we fund those deals.
Yeah.
Like it mixes together.
And it does. It does. Compared to other stuff. Like if we were full-time real estate agents and then we were, using our cash to invest in deals, different. But our deals are the lifeblood of our investor capital, our investment capital that we lend out. And that doesn't mean that, a good portion of our own personal capital, we're not investing in other deals outside of Hard Money Bankers.
Sure.
But both of our businesses overlap a lot in that. And I think that soon as a real estate investor can understand how to deploy their own personal capital into the mix, like you guys do into your own deals, that's when the magic happens. Because most real estate investors don't understand that. It's like you need to take your own personal capital that you have and treat it like it's a third-party investor capital. Create an entity for it. You don't have to even create an entity for it, but like this is like Ian's $100,000 in this deal, and that $100,000 should get a rate of return just like Joe Smith's private investor. Like you could be the private investor in your own company deal, and we kind of figured out how to do that. And it's a little bit easier on the lender side.
Sure.
But each of us have personal lender accounts where we lend out side by side with our own capital investors, and guess what? We get to double dip. We do a deal, let's say we do a $100,000 deal and me and Chris each have $50,000 into that deal. Hard Money Bankers gets the points. We each get, 50% of the 13% interest rate, 12.99 interest rate. Sorry, we've been changing stuff up to 12.99.
Oh.
Everything we do is 12.99 now.
Yeah, everyone else's rates are going up in the world, and yours
We're
are
going down.
Good for you, man. I like it.
I like that. You're right. 12.99.
But yeah, no, I mean, like my overall point was really a mindset shift to get away from walking around with dirty pants and like doing the day to day. And like we've done a really good job, busting into new asset class and cutting it up with some new vendors. We find ourselves getting dirty again, and it's like, all right, stop, just stop. Like we've done really well for a long period of time. Let's go back to what we're good at, pulling the levers and keep it moving. So.
It's all part of it, right?
Yeah,
all part of the game.
I know we've been going for a hot minute, but I got to ask Chris because we don't get him on all the time. What's your go-to podcast or book right now?
Right now?
Yes.
Fucking Hormozy.
Oh,
damn Alex
we were talking
Hormozy.
the other week. It's the same thing.
Everybody's Hormozy right now.
Yeah, Hormozy hot.
You sell a company for $100 million.
Well, what was messing with me before is that, and I was listening to him today, and we're gonna wrap up soon. But since you asked, a couple things on that related to some of this podcast is that he didn't even get a big hit from those sales of companies last year compared to what he was already holding. Right. He was like, man, I've been taking out $1 million a month for half a decade. So the hit from those sales wasn't even a big deal. Right. It was one number on the screen, and then it was a bit bigger of a number on the screen. And I'm like, God
Where'd
damn
you
it,
hear
Hormozy.
What
from his podcast.
Oh, you've been listening to his podcast. You read his book though, right? Or you haven't even got to that yet?
No, it's in my backpack.
What about the YouTube video?
What YouTube video?
Graham Stevens. Iced coffee hour or whatever.
No. I watched that whole thing.
Okay.
That I watched the whole thing.
Okay, good.
And we were texting about that one week.
Oh, yeah, that's right.
And then also, I was thinking about him earlier in this podcast because he's an active investor in multifamily syndications. And you were like, yeah, what's the structure that you were like, da-da-da-da. And I was like, man, I want to be Hormozy when I'm taking the whole LP and give me some of that GP while I'm at it.
Right.
Because I don't want to write too many of these checks. It's taking up time.
Yep.
Yeah, agreed.
Right.
Remember that, Ian.
All right, put the check up. We'll figure it out.
Let's go.
We can end on that note.
Yeah.
No,
we gotta go negotiate now.
I will tell you that I almost filled out that form on Hormozy's acquisition site, acquisition.com.site, just to analyze business.
You wanted to see his funnel. Don't lie.
I don't care about his funnel. His funnel won't be impressive. He even said.
His funnel won't be impressive. His site's not even impressive.
No, his site's not impressive.
Site.
No, just to have like a call with one of his peeps.
Yeah, invite him on the podcast.
Give some advice. We need to step up our viewership to get him on this podcast.
I mean, he's a Maryland boy.
Yeah, he went to Gilman, I think. Gilman or McDonough?
He's in Baltimore area, isn't he?
Yeah, Gilman, I think.
That's right. He said that on that Iced Coffee podcast.
Yeah.
Anyway.
So.
No, good stuff. Thanks for having me on.
He's legit.
Yeah, man.
Even though we're in the HMB
we're
office.
In your office. Yep.
We should move the camera around so we can see your office right there.
There's too many freaking cameras to move.
Yeah.
So.
All right. Until next time, check you later.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show
are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.